What's up, fellas? So we got the CPI report today, and if you've been watching the videos from earlier this week, and if you haven't, I encourage you to do so, we saw hints that indicated we would see a hotter than expected CPI read. The expectations were actually quite low. People were expecting the rate of increase, it seems, to have peaked in January, and we're expecting a lower than the 7% number this month, or last month, rather. Peaked in December. We got the January read today, rather. We did not think that. We saw two signs early in the week. Sign number one, the Department of Defense saying they were going to postpone determining their 2023 budget because of inflation. We assume the Department of Defense has very good information. We also heard the Wall Street Whisper number was about 5%, so that was a decrease. We saw the move out of the Department of Defense. And then yesterday, we heard the White House basically say tomorrow is going to be a high inflation reading. They didn't specify if it was going to be higher or not. But we, in conjunction with all of these hints, decided that there was a good probability that it would be. And in fact, it was 7.5% year-on-year inflation and added inflation over the last month. So we're seeing inflation. And the market was not. If you go back to the most recent sell-off we've had, and many people felt extreme pain in this year-to-date sell-off, over here we have not. Me and my clients are up 30% year-to-date, but a lot of people are not, and a lot of our stocks are not. And we have continued to hold those stocks, and we're going to continue to hold those stocks. I expect that it's possible we retest those lows, and previous to this, I had been bullish. The Friday before the low, it was a Friday, I called the lows on the Monday. I called capitulation. I said signs of capitulation, and we were pretty close to that capitulation. It was off by 1 day, is what it is. I think now I've changed my tune to I don't know if that is the low. It is possible that we get down there. Not just because of inflation. Inflation's high, but it certainly alone can't have an impact. If it were just inflation and interest rates weren't going to do anything, I would say bullish. Bring on the inflation. Inflation is a lift all boats event. Simply as a matter of accounting, if the numbers go up, the numbers go up everywhere. But that's not the case because we have rising interest rates, which are also numbers and dollars, most importantly, back to you, the bond purchaser, allegedly, that also increase. The Fed got meaningfully more hawkish today. They didn't do anything. They didn't give us anything concrete. They said one thing. Mr. Bullard said one thing that is totally new. And that's the notion of intra-meeting rate hikes. Before today, every forecaster I could think of and have heard, I haven't heard a single one that did the opposite. Thought that the Fed would raise rates at their meetings. They would have a meeting and they would raise rates. There's a wide spectrum of expectations from 1, 2, or 3 up to 5, 6, or 7 rate hikes for this year. It matters, but what is most shocking was that the idea of intra-meeting, so the Fed not even in its official meeting, raising rates. That is a meaningfully hawkish message. Bullard also says he expected a full 1% increase in the Fed funds rate by January. We're now in February. The Fed's probably not going to do anything tomorrow. They're probably going to wait until March. From March to, or not January, July. From March to July, that's at minimum 25% every month. Could be a 50 basis point move, or not 25%, 25 basis point increase. A lot of hawkishness. This is new. I was not foreseeing this. I was foreseeing inflation and then higher interest rate expectations. But the Fed kind of took, as Steve Leisman said, took that idea I had and shoved it. He kind of forced that into everyone. Not only can you have high interest rate expectations, but you really got to be looking at these guys over at the Fed because they got it wrong. And as far as we're concerned, they're going to live to fight another day, like all of us here on this channel, even if you are taking losses. We're going to live to fight another day. But they want to come back strong. And the way they can come back strong is, unfortunately for us, by being rather hawkish. Because there's a lot of rhetoric, a lot of saying they've gotten it wrong. Well, now they can come out and go jab, 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 really come out in force and change that perception and possibly get inflation down. Interest rates rising impact stocks. And some of you may know this, but I'm going to go over it for everyone. Because they provide long-term returns. The benchmark is the 10-year yield. You get a return over 10 years. As interest rates rise, the return on that bond increases. And you get more money back than you would with low interest rates. So when comparing the 10-year U.S. Treasury, which is considered risk-free, because in the absolute worst-case scenario, they can print money and give it to you, but they also get tax revenue and many other things. Risk-free, get a better return. Okay, I'll take a risk-free return if it's good enough, versus having to take some risk and possibly not getting a return at all. We get some more hawkishness, some more return out of the risk-free stuff. It makes the riskier stuff look a little less good. So uber hawkishness here might cause some panic in the market. And for some historical perspective, the last time inflation was at these levels, the federal funds rate was 11.5%. Right now, it's at 0. The Fed is continuing to do their purchases and their stimulation in full force. Bullard also said, in addition to the earlier things mentioned in this video, that he doesn't see why we can't remove stimulus at the same pace that we added it. So we've added stimulus via the Fed quite strong and fast starting in March of 2020. Maybe, I'm not saying it's going to happen. I think this is the hawkish end of the spectrum. I think we're not going to be at the extreme. I think we're going to be closer to the extreme than I thought yesterday, though. And the market thought yesterday. And we might see some substantial hawkish pullback. So we'll see what happens. That will probably mean some pullback for the market. If you've been watching the past couple of videos, you've heard my patient tone. I've had a cash position, and I'm going to deploy it. And I'm not going to sell my positions. And I have a wide array of positions. I have energy positions, which may or may not be impacted by the hawkish Fed. I still like those fundamentally. I have 10x growth stocks, which are down over the last year and may be impacted substantially by the Fed. I'm not sure, though. We'll see, because they are down 60, 70, 80, some cases 90% over the last year. And I've got some mining and materials companies, also in the energy bucket, and I've got some cash. And I want to deploy that cash because there are opportunities there. I'm not trying to sound super bearish and sour here. The economy is strong. We were expecting 5.5% GDP last quarter. We got 6.9% GDP. We had Omicron. We didn't have any bad jobs data. We had jobs data today. It wasn't bad. We had upward revisions of previous jobs data, and we had massive jobs beats. So the economy is remaining strong. What I'm concerned about, and what the market is possibly going to be concerned about and became concerned about at some point today, when Bullard talked, was the increased rate of return of bonds, which are much bigger than the stock market. So they're going to become more attractive. They're going to yield better returns. And maybe that'll impact the stock market. We'll see. Today was a decline. I'm going to be patient with my cash and see how this decline goes. I want to give it a couple days to settle because I thought this Fed today, Bullard, was meaningfully hawkish. I was surprised. The idea of intra-meeting hikes was not something I anticipated. I thought the Fed would do everything in meetings, make sure people were prepared for it, speak beforehand, be coordinated, soft landing. Today was a little bit, or a medium bit, or even a large bit, who knows, of a pivot off of that previous assumption and stance that I and many others had expected. So that's today's video. We got the piece of information we were being patient for, but it was quite heavy what we got today, quite heavy. And I'm going to exercise a little bit more patience with my cash. But because we had been prepared for it, I'm not going to do anything with my existing positions that I'm fundamentally still bullish on, because the economy is strong and those positions are strong for their individual reasons. So that's today's video, and until next time, peace out.